Welcome back, everyone. It is Thursday, January 4th, after market hours. It's NYU Grads Daily Podcast about stocks and finance. Um, I'm just kind of laughing at myself. The episode today, I'm going to call it When Chick-fil-A is Closed Sundays. And you'll see why when you see the animated GIF that represents the episode. I just thought it was kind of sad and funny. There's this court case that's going around on social media where the defendant leaps over the judge's table. It's just wild. People just don't fear consequences anymore. The funniest part was the security or the clerk that's works behind the judge's desk, just pounding on the defendant like whack-a-mole. It's quite crazy, but I digress. There's been a ton of bad news out in the news flow, and I hate to see it, but I'm not going to get into it with you guys today. Looking at breadth numbers, we had 165 new highs versus 121 new lows. Not too bad, right? Like, it's kind of like a wash, just like yesterday. But it doesn't tell the whole picture. I think we're going through a transition right now, and I'll cover that in a second. So we had 40% of shares advancing versus 55% declining. 21% are trading below its 50-day moving average, and we have 35% of shares trading below its 200-day moving average. And we're seeing some expansion in those two numbers, like the 50-day and 200-day moving average numbers. And we may be transitioning from weeks of, like 800 new highs versus 10 new lows. Just like back, in August through November, we were seeing, or August through October, we're seeing, 900 new lows and only 10 new highs. We might be transitioning to more new lows. That's something to watch out for and keep an eye on every day. As I've been saying since podcast number 1, if you're new here, I follow breadth religiously. It's my barometric reading. And what I mean by that is it's not the end-all be-all, but if you have a barometric measurement that just tanks while you're out on a hike, it usually means that there's going to be rain or some type of precipitation pretty soon. And breadth gives me that first warning sign of the market's intentions. And if you follow this every day, as I report on it every day, I promise you will start to pick up a nuance of how to read the tape and how to read the market and its intentions, because Wall Street cannot hide behind breadth. It's the literal mechanics, the piping of the market. If you start to see things that I was starting to see in the summer, where everything was the Magnificent Seven, that NASDAQ was up 200 points, but we had 1,000 new lows versus 10 new highs. That data gives you the intentions of the market, right? So that was telling me that everyone on the street were selling risk in the middle of the night, so to speak, while everyone was focused on the Magnificent Seven gains. And sure enough, eventually they got Magnificent Seven, and they all went down. And then one by one, each of the Magnificent Seven lost its 50-day moving average, and we were just sitting on the edge of a cliff. But in November, interest rates stopped going up. We just peaked at 5%, and they just tanked. We lost almost 100 basis points in a month. I don't want to go through the whole play-by-play, but that's kind of the big picture if you're new on what happened. My thesis is, all these talking heads are saying this and that about the Fed or whatever. quite honestly, we were sitting on the edge of a cliff, but somehow, some way, the Fed and Wall Street manufactured at the last second in November a 100-point basis rate cut in the 10-year, went from 5 to 4, and actually went under 4, down to like 3.5. So that was the rally. That was the Santa Claus rally, because it started well before December 13th and the FOMC meeting. That just was icing on the cake. Looking into today's complexion, it wasn't that good. We had a really ugly Tuesday, the first trading day of 2024. We had a semi-ugly Wednesday back-to-back. And Thursday, you would expect them to try to bounce it, and they did. They did till about 11:45. And you're thinking, hey, we're rallying at 11:45. The lunchtime algorithms are going to take over, and they're going to bid the price. But they didn't. It sold off right around lunch, like 11:50. And we closed at the lows. So the Dow closed up miraculously. It has, obviously more of the mega cap defensive names outside of like Apple and Microsoft. But it closed up 10 points, 0.03%. But it closed at the lows. It closed where we closed on Wednesday. The NASDAQ closed down 81 points or 0.5%. And the S&P closed down 16 or 0.34%. Not a big deal, but it's the complexion of it. If you add Thursday, Wednesday, and Tuesday, it's been an ugly first week of 2024 so far. And then you take a look at the Magnificent Seven. So on Tuesday, they were picking on Apple. Barclays downgraded them, and they were down big. Yesterday, they were picking on Tesla. Today, they're picking on Amazon. So Amazon was down 2.63%. Microsoft was down 0.72%. Apple was down 1.27%. Tesla was only down 0.22%. But the only two Mag 7 stocks that were green were Nvidia up 0.9% and Meta up 0.7%. That's it. The leading sector, anyone want to take a guess? Healthcare. The leading red sector was energy, then communication services, consumer cyclical, and then technology. When you have healthcare leading, it's almost as bad as when you have Procter & Gamble and Campbell Soup leading. So it was an ugly week so far. It was a salvageable day, and they had every reason to try to rally this, but they couldn't. So that tells me a lot. Friday in the morning, you do have the unemployment/employment report coming out at 8:30 in the morning, as well as hourly wages. You have ISM services at 10 a.m. and Tom Barkin from the Richmond Fed speaks at 1:30. That was kind of the summary of the markets today. One thing I do want to point out, I follow real estate really closely because, not to get too personal, but I will share this. I live in New York, in Manhattan, like true New York, right? Like not like in Long Island. I grew up here since 1982. And before COVID, I was actively seeking to buy a home. I won't say where, but let's just say west of Texas. And the first touring I did was decent. It wasn't too crazy. But as we got closer and closer, obviously, to the whole COVID pandemic, what I was starting to see was just bubble type activity where open houses had like 100 people, cars lined out, whether it's a private sale or a new home build, there were just 30 cars stacked outside. people were, making multiple bids. New home builders were like, take it or leave it. You have to waive appraisals. You have to waive inspections. It was like best and final offers. And I was just like, this isn't my first rodeo. I have been around. I was in college day trading, cutting class at NYU, day trading Ask Jeeves during the dot-com crash. I was trading during, the Great Financial Crisis. And at the time, I was a homeowner right before that financial crisis. I was able to get out before the meat of the crash started, but I lived through all of that. So when I started seeing this, I was like, I can't buy now, right? I hate renting, but I can't buy now. This is just too crazy. It would be cheaper for me to rent and wait. And keep in mind, interest rates were very low pre-COVID. I decided to wait because the prices were just escalating so fast. There were lot premiums that were doubling and tripling every month. I would go visit this location in the city every month or so to look at homes. Lot premiums were doubling every time I went for new home builds. I was like, this is madness. So I'm waiting. And I'm waiting for a few signs, and we're seeing some cracks here. But the reason I went on this long tangent is I follow Reventure app Nick Gerley on YouTube, who's excellent. I followed him from the beginning when everyone was rolling their eyes saying, there's no housing crash. What are you talking about? And he and a few others like Melody Wright are boots on the ground. They tour the country on their own dime to give tours of the situation in multiple cities. And he posted an excellent video, which I'll share in the show notes, about Blackstone. And he's not picking on Blackstone all the time, but this time he was. And the moral of the story is that Wall Street landlords are defaulting on commercial real estate, not residential. And that can potentially have some big impacts and ripple effects in the banking sector. And I agree with him. When you take a look at New York City, we have the largest vacancy rates in the country next to San Francisco. But San Francisco is not even a close second. So who is going to bail out the landlords? We'll have to see. I think this is going to be an interesting 2024, but I'm not in any rush. Even if rates go down, mortgage 30-year rates go down to 4%, I'm in no rush. I'd actually rather pay 8% mortgage. I'm not going to get a big mortgage, to be quite honest with you. I'm going to do mostly cash. But if I had to, I'd rather pay 8% mortgage on a house that is discounted 30 to 40%. So I'm waiting. I'm fine renting for now. So what was strong today? I mentioned healthcare and financial. The 10-year yield is not going down. This should scare the crap out of those that are perma-bulls, because if the 10-year goes to 4.5, you're going to start to see some of those screws come undone and the walls start to shake. What was weak? I mentioned the sectors, but to see 5 of the 7 Magnificent 7 in the red is not good. And keep in mind, keep watching the Magnificent 7. Keep watching yields. Keep watching potential commodities that are interest rate sensitive and or inflation sensitive, like oil, copper. Speaking of oil, there was an excellent post a video from Adam Taggart on YouTube, which I shared on Substack Notes. You should definitely check it out. It was interviewing Doomberg on Thoughtful Money, and I learned so much about oil. I just learn all the time from Adam and his material and guests, but especially when you mix Adam and Doomberg together, it's just well worth your time invested. So I'll post a video of that too on the show notes if you missed my Substack notes. That's all I have. I kind of rambled today about housing and real estate, but I also want to thank everybody that is coming on board this week. I'm seeing a lot more traffic and subscribership, so everyone that came on board this week, thank you so much. I hope you enjoy the ride and you stick with it. I will be launching a premium service once we get to about 3,000-ish total subscribers. We're a little bit over 2,000 now, so it won't be too long before that happens. So that's all I have for today, and have a great evening if you're listening to this on Thursday, and I will see everyone after the Friday session. All right.